We are joined by Tushar Bansal, Director at IV Global Energy. He's joining us from Philippines. So Tushar, OPEC has finally come with an agreement which nobody believed would come through. They've agreed to a production cut of 1.2 million barrels a day. Now the structure of the deal is that all countries have been given quotas. A third party is going to regulate and oversee these quotas being met. Of course, there are exceptions of Nigeria and Libya who do not have to meet the quotas, and even Russia is saying that yes, we will also join in. Do you think this deal is going to work?
Yes, I think this deal is eminently workable. It was, to be fair, I was expecting a cut of eventual 800 to 900,000 barrels a day. And it was, as I said last time, it was workable if Saudis agree to cut 400 to 500 and the others take on a roughly 100 KBD each. That seems to be what the path which they have taken broadly. Iraq coming in with 200, the others with 100 to 130 each. And so the other key point, which is not really mentioned in a lot of the news reports, is that the other OPEC members, including Iraq, have agreed to go by secondary sources to count their output, not thus their own official declarations. This is very significant because this means that you would count what third parties are saying about how much you're producing rather than go by your own declarations. So cheating is going to be, there's going to be less incentive, there's going to be less possibility of a cheating. I'm not saying it can't happen, but it's not going to be as easy as just declaring that you're actually producing less when you're in fact producing more.
Okay, so you think this is workable and this is durable. What do you think will happen to crude oil prices? Are they headed towards $60 a barrel, even higher? What's your call on crude oil prices?
I think they're headed towards $60 a barrel, but not much beyond that in the short term, because at that level, then shale oil starts coming back and you see other projects starting to go as well. Now, if the Nigerian or Libyan outages occur at any point of time, then you could have a potential for oil prices to go up beyond 60 towards 65 levels. But in the short term, they are headed towards the $60 levels.
All right. Now, how effective is this going to be to cut the oil glut? What is the extent of the oil glut now? Because, after the crude fell sub $30 a barrel, it has largely been very range bound and it's stabilized. Is there a huge glut at this point of time?
The glut varies seasonally. So right now in December and Jan, where we have the winter season, the glut is just around ballpark half to 700,000 barrels a day. Come summer, come second quarter of next year, the glut will be as much as 1.6 million barrels a day, so, barring this cut. So with the cut in place of 1.2 and assuming Russia does not add on to it, Kazakhstan or Azerbaijan do not add on anything to it, we are largely going to see a very balanced market, which has a potential to put prices significantly up in case of any shock, be it a demand shock or a supply shock.
Right. What level does it become attractive for US shale producers to come back?
Around between 60 and 65, it becomes very, very attractive.
So then,
because their costs, depending on the basin, their costs range between $20 up to $50 or $55. So at 60 or 65, they start getting very decent rates of return, depending on the basin.
Right. So, do you then think that crude oil prices are going to be capped? I mean, you don't see them much higher than $70 a barrel because, then shale production also comes through.
In the very short term or in the medium term. However, if we look out 3-4 years down the line, then oil prices are poised to go significantly higher because the investments have dried up. You have demand rising by 1.2 to 1.6 million barrels a day year after year globally. And you need incremental production to capture that every year, which is not coming through, which is not going to be there in 3 to 5 years time because you have stopped investments right now. So with this cut, oil prices are poised to go significantly higher in the medium term, in 3 to 5 years time.
The expectation and the belief is that the OPEC has agreed to a production cut because they have their sights set on inventories, which have been pretty high, and they want the crude inventories to really correct. Can you tell us what are the inventory levels like, and do we expect a significant correction in the inventories?
See, inventories will take some time to be drawn down, and they will be drawn down based on the market conditions. So market conditions have to change from contango to backwardation, and then inventories will start drawing down. Now, based on the current levels of inventories, it would take between 6 months to a year to draw them down to significantly lower levels than what we have seen recently. Now, they will, however, continue to remain high in the short term, in the next 1 to 2 years, because of the levels that have been reached. But given that we are very close to a balanced market situation, and given that demand continues to remain strong, we should start seeing a drawdown definitely in the coming towards the third quarter of next year.
Right. The fact that Russia has agreed to, partner in this deal, it of course doesn't have a quota. How soon do you think Russia is the biggest exporter, crude exporter? How soon can it, reduce its production, and by how much do you think Russia will reduce its production?
Russia is the largest oil producer, and its production is difficult to cut, to be quite honest, because it's not just a single producer like in the case of Aramco or ADNOC. It's through a number of different producers. So you would expect a maximum of 200 to 300 cut, if at all. So as of now, I'm not counting on any significant cut in Russian production. But even barring that cut, we are poised to see market balancing, and essentially any further cuts added on from Russia, even 100 or 200, will continue to tighten the market.
Right. While Russia has agreed, there are some other non-OPEC producers also, like Venezuela, like Mexico. How important will their decisions to cut be? Because I don't think they're really looking at cutting their crude production. Do they really move the needle at all?
Not really. For Mexico, it's pretty difficult to cut because they're already producing as per what they can. They don't have too much headroom. What can happen is they can go slow on the further rounds of licensing, or when they are looking to increase their production, but that is not going to come in at least until 4 to 5 years time. So there isn't too much of a room coming in from Mexico. Venezuela already is producing below its capacity because of the round of oil price reductions impaired its ability to invest in its oil field. So it's already producing below what it can. So not much of a movement expected from there, but the major cuts expected continue to be from Saudi, from UAE, from Kuwait, from OPEC essentially. Only a tidbit incremental cuts expected from non-OPEC, Azerbaijan, maybe Kazakhstan a bit, Russia maybe 100 to 150 or so. Not a whole lot coming in from there, but any extra bit, once the market is balanced, any extra bit adds on to the tightness.
Right. Now, we've spoken fairly about the supply side. Let's talk about the demand side as well. There is an expectation that there will be a fiscal stimulus in the US, and the Chinese markets also seem to be stabilizing. Growth in India is also expected to be strong. On the demand side, do you think there will be a greater demand for crude, and then there will be a further upward pressure on crude prices?
Crude demand is expected to be strong because new refineries are coming on stream in Taiwan, new condensate splitters are coming on stream. So crude and condensate demand is going to be strong. Product demand is going to be not as strong as you would expect to see in $40 oil regime. So previously, if you look back in history, when oil reached $40, oil demand should have started increasing by around about 2 million barrels a day. It is not, and it won't. So it will continue to be about 1.2 to 1.5 to 1.6 at max million barrels a day. China is growing, but not growing as strongly. India is growing, but in the short term, because of the impact of demonetization, you could expect to see a bit of impact on the short-term demand growth. US continues to grow strongly. So overall, demand will continue to limp along, 1.4, 1.5 million barrels a day, but it won't reach 2 million barrels a day. Now, what that means is that you are expecting to oil demand to grow at moderate levels, which would be sufficient to be met by inventory drawdown and by the cuts which are happening, which means that you, at this point of time, do not expect a demand response, a significant demand response.
All right.